First one from James. He said, how should novice investors best communicate their ideas to their financial advisors? I think that's a really good question. I think the number one thing that we encourage people to do is just talk about what money means to you. Talk about your goals. Talk about where you would like to go with your money. And then from there, start just communicating, hey, this is where I'm spending, this is where I'm not. You don't have to have, a degree in finance to take control of your finances. It's just speak in general terms and say, this is what I'm hoping to do. And if you're working with a good advisor, they'll be able to bring that back to you from that. So hopefully that answers your question. James, Winston had asked, is the chance for a recession higher than 50% or a lot less? Our model does not base the our outlook on, yes, we're going into a recession, no, we're not. What it does is it looks at the trend. And are we going to be decelerating and running below trend? Or are we accelerating and running above trend? Or are we just kind of going at trend? The average is 3%, but unfortunately, we've been lucky to hit 2.5% lately. That's kind of now the norm until we fix our budget deficit and trade deficit issues. So our model does not say more than 50% chance of recession. It will never say that. Based on my using this model now for 30 years, it's not saying we're likely to have a recession, just a slowdown. But what that becomes important with is that slowdown enough to drag down the cash flowing into stocks, especially the AI related stocks, which have been propping up the market. If it does, if it slows enough, that 16% earnings growth might only be 8%. So if you cut earnings growth in half, where stock prices are, you could see that 25% drop. That is the average bear market without a recession. Now, it will come down to jobs. Jobs are going the wrong direction, but if the Fed cuts too quickly and inflation becomes a problem, that could actually accelerate job losses. The number one indicator of a recession is a decline over 3 months in the number of jobs or 3 months consecutive increase in the unemployment rate, and we haven't seen that yet. So we're going to watch closely the jobs data, not just that comes from the government, but like we mentioned, ADP, and see like that. So Winston, the answer to your question is our model right now is not saying more than 50% chance. For now, it says a lot less, but we are decelerating in terms of growth. Tanya asked, how do I maximize retirement at 54? I am behind. This is a really good question and something that we really enjoy doing. A lot of our social media work is related towards this. Is number one, it comes down to basics. How much are you spending versus, how much are you making? At your age, and we've seen people be able to do it, you got to figure out, how do I cut down all my wasteful spending? We're not a Dave Ramsey, rice and beans, beans and rice, but you definitely got to look at what is essential and what is not essential, because the first thing you got to focus on is eliminate all consumer debt. So that starts with credit cards, and that starts with all these furniture loans and other loans that come at you. I mean, I get like 3 calls a day, somebody saying, hey, we have a $50,000 pre-approved loan with low interest. Get rid of all those loans. Work on the getting rid of all your debts, and then start on car loans and do that. When those are eliminated, whatever dollar amounts you were putting there, say it's 500 a month, 1,000 a month, that has to pour into your investment accounts. And that's the only way to do it, is figure out, how do I make sure I'm spending less than I'm making? How do I get out of my consumer related debt? And how do I just pour all of that into your retirement accounts. And we've seen a lot of people, if you can eliminate your consumer debt by the time you're 65 and claiming Social Security, you should be okay if you have built up that nest egg over those 10 years. So hopefully that answered your question. Um, Philip asked about cryptocurrency and precious metals investing. This is a really good question. Gold is up 100% using GLD, the ETF that's based on gold prices, 100% since April 2025. So if you want to talk bubbles, that's probably a bubble. Now the buying started actually in April 2024, and a lot of that started around central banks around the world increasing their gold reserves because they're fearful of what has been thrown about of the US basically devaluing our currency in order to pay off our debts, which is something both the Trump administration and the Biden administration have talked about. Some of the people that are looking at becoming the next Fed chair has talked about how you could just drop your currency and basically pay back your debt at a lower value of the dollar. So people started accumulating gold. However, gold literally made zero money from 2011 to 2024. You lost money for that long of a period. For us, that's too long. If you feel comfortable with some gold in your portfolios, that's great. In our quantitative systems, what we've always found is when we add precious metals as an option, our returns have gone down and our risks have gone up. And that's because gold lost 20% this year in something like 6 weeks. It's had drawdowns several times of 45%. So you've got to be careful with that, of having too much gold or precious metals in your portfolio. You're going to pull it down. What we found when we dug into it is the reason it would lower our returns and increase our risk is gold oftentimes takes over your large cap growth or your technology investments. And this sounds weird to say, but technology or growth stocks have been a better hedge on inflation than gold has historically because inflation actually increases the earnings of those stocks. Now, granted, we've been in a low interest rate environment, so that might change. But we've always found in terms of our models, it just doesn't work. Now, EGA, Enhanced Growth Allocator, can get some in there once in a while. We have some funds in Income Allocator that once in a while can get into some precious metals investing. In terms of crypto, my joke last week was, hey, looks like Bitcoin is having a Black Friday sale. It's 40% off. I don't say that lightly because, full disclosure, I have investments in cryptocurrencies. We're looking at, having a digital asset portfolio that I'm a big believer in the digital payments infrastructure, but it can lose 60 or 80%. And we're seeing that, with Bitcoin. And I always, I point out, if you loved Bitcoin at 125, you should really love it at 88, which is where I think it was this morning. So it has to be a long-term investment. Crypto, like gold, because it can lose so much and because it can spend long periods of time not making you money, if you put too much of your portfolio in there, you miss out on the long-term benefits of owning the stock market. So hopefully, Winston, that answered, I'm sorry, Philip answered your question. George asked, kind of a basic question, are these still uncertain times? Are they calming down? I mean, obviously, we're still in very uncertain times. You can see Truth Social posts changing the direction of the market. Policy goes out sometimes, whether it's economically based or not, simply when, the president puts something out there. We've seen, I'd say, a more market focused president, um, in terms of not, not causing too much harm to the markets. So I think that part has calmed down a little bit. But definitely, going into midterms, next year could be very volatile if the Republicans really try to push things through. I cynically always say, Congress will be trying to buy people's votes with all of their policies as they head into midterms. So I think it's always uncertain times, and this goes back to something I saw somebody ask on LinkedIn of um, how do you talk to somebody who is concerned about the political environment? And I always say, and I said this a year ago in our post-election webinar, of do not let your political opinions influence your investment decisions. And the reason is we've seen Republicans have good markets, we've seen Democrats have good markets. The best markets long term have been where the White House and Congress is split. Well, right now, one party has control, so they might be able to do things that long term is not good for everybody. And the market tends to kind of hedge their bets a little bit. They like when the government is not able to do much because then they can't do much damage. So hopefully, George, that answers your question is, it's always uncertain. But the certainty we have is that human nature will repeat and it will go through cycles. Janelle asked, she's just said, I'd love to hear Jeff's 2026 outlook and curious about AI and how he sees that trade playing out. I did say it, but just to answer the question, I'm more concerned with the financing of the data centers than I am with the stocks because what's different from this bubble than the tech bubble is right now the companies that are driving everything are very well managed in terms of their balance sheets. The reason they're doing this off balance sheet stuff is they have a AAA credit rating because they barely ever borrow money. And when they do, they're able to pay it back really quickly without any hit to their earnings. Whereas in the 90s, a lot of the people who were driving the growth were having to borrow tons of money or issue a bunch of stock to finance it. So I'm not as concerned with the stocks. What I'm concerned about is how much capacity we need and when these investments will start to pay off. Michael Burry, a lot of you might know, is Christian Bale's character from The Big Short. He's pointed out depreciation schedules, and this took my accounting brain back to the late 90s of there's accounting tricks going on to make earnings look better because he's arguing that a lot of these chips, because they're running at such high speeds, they were thinking they were good for 7 years if it was just for like an Amazon Web Services data center. So they're depreciating the cost out over 7 years, where in reality, these chips are only good for about 12 to 18 months before they have to replace them. So the cash flow starts to be a problem with these companies. That said, so long as we have the hundreds of billions of dollars going in to the financing of the data centers, we will be okay. But once that wheel stops, that's when these companies will have to decide what to do with the data centers. We got our whole utility infrastructure to worry about. They're sucking so much energy on an already weak utility system. I would love to see some sort of partnership where the government comes in and actually helps get the utility infrastructure up and to today's standards across the country, because that's one of the things we are lacking. The other questions, and keep them coming. We'll stay here as long as necessary. Um, Tim, we'll go in order. Regarding the government spending slide, why was there such a big dip in 2022? So let me go back to that one. Um, that is literally because of the stimulus. Notice, I can get my laser pointer back. Notice all other surged. That was all of the emergency measures that we took, the deficits we ran. So remember, this is a percentage of spending. So because we were running a deficit of, and let me go back to the actual spending, $9 trillion of spending, up from 5 trillion, all of that went to special programs that, made the percentage less. So we still spent the same amount on retirees and everything else, but because the spending um, was done, there. So hopefully, Tim, that answered your question. Um, Preston says, with S&P generally outperforming many actively traded funds this year, do you think the recent extreme daily volatility could be partially responsible due to active traders' attempt to meet year-end return goals? Yeah, that I I go back to, and I just was at an advisor's office yesterday, and we were talking about that. Um, and kind of let me go to not this slide, but the one before that as support is we definitely have it, a lot of indexers out there. You think of Dr. Richard Thaler pioneered, behavioral finance. One of the things he talked about was nudges. Part of the policy changes he implemented was auto enrollment into employer retirement plans. So you have to actually do work to opt out because Dr. Thaler found if we had to do work, we tend to not do it. And so you have all this money going into target date funds, which will just buy every 2 weeks with your paycheck. So you have built in what we call dumb money because they don't care about valuations. They just care about being in the market. So you definitely have that built in. But the issue we've had is the more active people have then also been pouring money into the Nvidias and Microsofts and Googles and everything else, so that the S&P is 40% represented with just 10 stocks. So I would not recommend to a lot of people that you put almost half your money into just 10 stocks, especially when 8 of the 10 are technology stocks. That's not a very well diversified portfolio. So the recent volatility that we're seeing on a daily basis is, and similar to the analogy I've used, is the non-indexers, those who might be a pension fund, a hedge fund, somebody who is just trying to report, is the analogy I use is everybody understands the market is trading at all-time high valuations. All-time high valuations are okay if growth is going to be above average. The expectation is above average growth. Every drop we've seen and some of these wild swings we've seen is at any point there's a threat to those valuations. And again, going back to the analogy, metaphor, whatever it technically is let's just say hypothetically that you're speeding down the interstate and flow of traffic has you going 3 miles an hour over and then 5 miles an hour over and then everybody's suddenly going 10 miles an hour over and you're like, well, if I go any slower, people are just going to be, I'm going to be more dangerous. So then you're going 15 miles an hour over the speed limit. When that lead car sees just a random vehicle sitting in the median, that lead car hits the brakes because they know they're speeding and they shouldn't be speeding. And then that causes a chain reaction. So the volatility that we're seeing is everybody knows that this run in the market is not normal and is only supported with strong growth. One of the reasons we saw volatility, and I put this in the blog last week, Google announces a multi-billion-dollar deal with Meta to buy their chips instead of NVIDIA. Google goes up $20 billion, NVIDIA goes down $140 billion. The math doesn't make sense, but when you start to say, well, maybe NVIDIA doesn't have a monopoly, people in NVIDIA said, well, I need to get out of my NVIDIA stock. So the volatility you're seeing as non-indexers, knowing that they're speeding and needing to get out. What will be a concern to those indexers is the lag that we typically see. And everybody's different. You could literally check your 401k balance or TSP balance every day now. But a lot of people wait till they get some sort of a statement, whether it's monthly or quarterly. Once in a while, they'll log in and look at the investment choices. And I've seen this happen too many times with people's 401ks. They'll look at what's done well the last 3 months and then make a switch. So what we found is if you get about 9 to 12 weeks into a decline, that's where the second leg down happens because now these indexers that were money always flowing in blindly to the market, they're looking at their options on their 401k and saying, oh, these low risk funds lost less money and they pull out of it. So that's that other down leg that we see. So I think, Preston, what you're describing as window dressing, and I don't see that as much as the active managers have been playing catch up by being overweight tech, and now they're trying to pull back. So hopefully that answered your question. Winston, is AI data center investments a good one? And with that, I will say it depends. And it depends on where you're at in this chain and how early you are. If you're a big tech company, the way they're investing is a very good investment because they're only taking about a 20% ownership and letting somebody else finance it. And then they're just signing a lease. They're not even have to put up cash. They're letting other people put up cash. And then they're hopefully going to be able to generate earnings from that. If you're out here investing in the debt and then you're investing in them via structured notes, you don't know what you have. And I know they try to say, oh, we're going to be diversified across different, data centers, different tranches. We're going to diversify that. History tells us that the late stage data center investments or any of these structured financing deals are going to mean you lose a lot of money. I don't know if we're early stages or late stages. If we're early stages, it's probably a good investment. But the question is, how do these companies make money? OpenAI, which owns ChatGPT, they've made about $700 billion in promises over the next 5 to 7 years to all the big name companies, NVIDIA and Microsoft and Oracle and Broadcom and, a who's who of people. Cloudflare, I think, was one of them. $700 billion. Over the last 12 months, OpenAI has generated 13 billion of revenue. Yet they're promising $700 billion. Now, their stock is private, so it's worth whatever they want. So a lot of these deals, they're just giving people stock. But I asked ChatGPT, I said, let's assume only today's paid users is your user base. How much would you have to charge the paid users per person per month to break even? And the estimate that ChatGPT gave me was anywhere from $110 to $125 a month. That's for one AI tool. ChatGPT can't do graphics very well. ChatGPT cannot create Excel documents or charts very well. ChatGPT is good for one thing. So how are all these companies going to get customers, businesses, and consumers to pay enough to continue cash flowing these data centers? I don't know. I just can't tell you. And for that, I just say this is definitely something we cannot advise on as a data center investment because I couldn't go on site and read all the documents behind these notes that are financing the data centers. So that is all I have to say for now. I've been talking about it almost nonstop since our newsletter posted at the end of the quarter. So I will probably keep talking about that. So stay tuned to the blog. Um, so Tony asks, based on this crazy market, are you surprised by any performance of the various models, tactical, dynamic, and strategic, either positive or negative? That's a really good question, Tony. And I meant to get to that in the prepared comments, but I wanted to keep it at 30 minutes. So what I will say, and what Tony's talking about if you're new to SEM, is we designed everything. First of all, there's no opinions involved in anything we do. It is quantitatively based. SCM stands for scientifically engineered models. It is all rules based that can be tested back over time. We design different styles because we know these styles will have problems going to, at different parts of the cycle. So let's just go in order. Tactical are our most low risk models. They watch the market every day. They don't trade every day. The most popular ones are out here: Cornerstone Bond, Tactical Bond, Income Allocator, and Tax Advantage Bond. So the first three, Cornerstone Bond, Tactical Bond, and Income Allocator, notice on this scale, they are very, very low risk. And it sounds funny to say, and past performance is not a guarantee of future results. These numbers do assume you were invested the entire period with no cash flows in and out. But generally speaking, these models, net of all fees, are tracking around 4 to 5% for the last year. Actually, some are closer to 6%. When you consider the 10-year Treasury is yielding 4, and the 10-year Treasury can go all over the place. The 10-year Treasury has lost 22% historically. I'm extremely pleased with these models. I'm extremely pleased that they sold early in Liberation Week. Remember, that was in April when the president announced, across the board 15% baseline tariffs. They got back in. They sold high yield bonds early April. By around the 24th, 25th of April, they got back into high yield bonds, and they've been there. They've weathered these little scares and stayed invested. So I'm extremely happy with our tactical models. Now, 4 to 6% sounds like really low returns, but remember, this is your shorter term money, your low risk money. This is where we have people taking money out to live on, so you can't have a lot of fluctuations in value. So ironically, our lowest returning models are the ones I'm most happy with. Now, tax advantage bond uses municipal bonds. Municipal bonds have had a terrible run. They're barely break even for the year. And so that is disappointing, but they tend to not be correlated with high yield bonds on the corporate side. So maybe that's a sign that, maybe they're going to turn around. Jumping to the next one, obviously the most disappointing is our dynamic models. The dynamic models were neutral going into the year. That makes sense they've gotten the economy right. We were running at 2.5% 12-month GDP going into the year. We're down to 2.2%. Again, the last 20 years, our average is 2.5. Our model went bearish at the end of June. It's been right on the economy. Where it's been wrong is our model obviously doesn't factor in where half of GDP growth is coming from data center, private investments. Like that's boosting everything up. So the AI data center build out is literally propping up the economy and the stock market. So the dynamic models I've been disappointed in that the economy and the market have not lined up like they historically do. But that said, there's been times where it's worked out well. The other thing I am encouraged from on the dynamic models is like with dynamic aggressive being half invested, it's doing better than a 50% investment in S&P would do. And it's in a position where if the economy does go into recession and that financing side of the data centers gets, stalled out, we're already in a bearish position, so it should weather that storm much better. Same way with dynamic income there. So that's been my most disappointing. The strategic models, which is designed to be our longer term models, I'm disappointed in our numbers in that we did not and we will not be able to keep up with the S&P 500 um, or even like a broader based buy and hold benchmark that's always invested in stocks. And you can tie it really to two things. Number one, we were too heavy in growth in the first quarter. And then when the Liberation Week tariffs hit, large cap growth got hit the hardest. Our rebalance just so happened to happen that week. And we balanced out of growth and into more international. And then that's just in time for international to start lagging. So that's a little bit of the underperformance. But what really has hurt our strategic models, and by the way, we're talking about 4 to 5% difference from the benchmark for just this year. If you look at 3 year numbers, they're all basically in line with their benchmarks because in 2022 we lost less than the benchmark. So I'm only talking about calendar year 2025 in my disappointment. Liberation Week was one of the scariest times I've seen since COVID. We've had some little hiccups. We had some things, but I don't think people understood what was happening behind the scenes in that we were literally looking at a market that was on the verge of collapsing by a whole lot of different people and data points we looked at. And again, this was not our opinion. We followed the models. And so one of the trend models in Amerigard and Cornerstone got a sell signal on April 6th. And that was the day after the Liberation Day announcement came out. The market was down 4 to 5% over those 2 days. And the market just kept going down the next several days into the weekend. Now that we have the post-mortem of what was happening is we saw spreads just going through the roof. So the spread is the difference between if you're trying to buy and sell, because there was so many institutions trying to sell, you weren't able to get really good fills. So people were starting to panic and pull money out. We saw usage of the Fed's emergency liquidity windows go up to the highest levels we'd seen since COVID. We saw derivative instruments just not pricing. We saw mutual funds unable to price their derivatives. We saw all these things going into the weekend. According to the Wall Street Journal and Fox Business and a few others who reported on this, the president was refusing to talk to anybody from Wall Street. Treasury Secretary Bessent was not taking any calls from anybody from Wall Street. The banks were calling the administration and saying, things are collapsing. You need to do something about this. And they just were not taking the calls. So Jamie Dimon decided to do an end around. He knew that every morning the president watches Mornings with Maria on Fox Business. And Jamie's people got him on with Maria Bartiromo to open the week on her show. And he talked about the liquidity crunch. He talked about the bond market just shooting yields higher. He talked about all the concerns of businesses and how this would shut down capital expenditures. So after the show aired, the president calls Maria, and again, the Wall Street Journal, reported on this and Fox confirmed it. And he said, "Do you believe what Jamie was saying?" And she goes, "Yeah, I see it." And he goes, "Yeah, he made a lot of really valid points." Shortly after that phone call, the the issue was um, that he put on Truth Social, now would be a good time to buy stocks. So shortly thereafter, Treasury Bessent said, we're doing a 90-day moratorium. The market bottomed, was up 10%, and kind of the rest was history um, from that. So we had sold our models because it was not a broad-based rally off the bottom, it was all large cap growth driven, stayed out of the market with that 15%, and now we're lagging. And the market really hasn't given us a chance to catch up by having less risk. So, Tony, to answer your question, I'm not so much surprised. I'm okay with the fact that we sold because it could have gotten a lot worse. I'm glad it didn't. I'm very thankful. I think since then, the president and Treasury Secretary Bessent have been plugged into Wall Street. I don't like the acronym TACO of Trump always chickens out. I do think that the president is more wise. And I do have this caveat, if you're still listening back to Janelle's question on my outlook, I would not be surprised, and this is not a bullish thing over the next 5 to 10 years, but for 2026, if we start to see hiccups in the data center financing, if we start to see private credit funds in this space going under, I would not be surprised to see whoever Trump's new Fed chairman is, along with the Treasury Department, buying these bonds and these notes. Like they're that in tune to what is happening with that. Um, so hopefully, that answers your question. Again, we're only talking about this calendar year. If you go back over 3 years going to 2022, we are quite pleased with everything. What it comes down to, and again, the risk questionnaire is there for you if you're wondering about your portfolio allocation. This literally generates somebody, a human, looking at your portfolio to say, yes, we should make tweaks. Because how you're invested comes down to your financial plan, your cash flow needs, the objectives of that money. Like we have a lot of people, they don't ever need this money. They're going to leave it to their kids or the charities or something else. Let's ignore the volatility that we're going to see over the next year to 3 years. That's what this risk questionnaire is designed to do, is to kind of figure out, well, are we in the right portfolio for you? If it's shorter term money and lower risk money, that's where the tactical models come in. And again, I'm quite pleased. I could not be happier where they're at. Even though it's mid-single digit returns, I'm very happy where we're at given the market that we've had. So hopefully, Tony, that answered your question. Finally, unless anybody has anything else, will the young members of Congress that you desire have the courage to make the hard decisions on government retiree spending, like increasing the retirement age, increasing the salary limits on contributions, etc.? This could be a whole new webinar. I've probably promised it for 10 years because I've answered this question for a long time. I think what I've missed out on is not understanding, one, how much healthier we've all are, and how much desire the older generations have had to continue working, including working in Congress. What I've always said, and this will be the very short version of it, is I used to always call the millennials that everybody gets a trophy generation. And that is because, oh, we can't have anybody losing. But what we also saw was a very big focus on group projects and finding leaders who could pull along the whole group. We've also seen millennials in general be a very outward looking society, greater good type generation. And I know a lot of times that gets grouped into the threshold of, saying, oh, that's socialism. What we've seen, and by the way, this goes all the way back to 2011 when the Simpson-Bowles Commission, which was a bipartisan commission, came out and said, how do we solve our deficit problems? Remember, this is when the Tea Party was wanting to shut down. They did shut down the government for a while. We saw the US lose its AAA credit rating because of the spending going on. Part of the agreement to reopen and raise the debt ceiling was we would create this bipartisan commission. The problem is nothing got voted on because they had to have something like an 80% agreement to have anything go through. But there was a lot of things that Thomas put in this question in the Simpsons Bowles Commission to give Social Security another 25 to 35, 40 years. They're already raising the retirement age. Um, I forget what mine is now. I'm 51. It might be 72, 73 now is full retirement age. It's already going up. The other things we're likely to see happening, which are kind of the low-hanging fruit, low-hanging fruit being the things that offend the least amount of people, getting rid of the cap on Social Security earnings. In other words, when you reach a certain income level, you just stop paying in. The one I haven't seen done, which I would love to see done, is the carried interest loophole. Make that part of Social Security and Medicare and make those hedge fund and private equity managers pay into Social Security like the rest of us have to do. Every president since Bush has talked about closing it. When they get time to do it, Wall Street influences them to tell them not to. Um, Things like that. Um, Honestly, I could see this happening is means testing. You know, we have means testing with Medicare. Hey, if you're over a certain income, you're going to pay higher premiums. You keep having IRMA come in. The proposals I've seen could see means testing. Hey, you have a $6 million Roth IRA, you're not getting Social Security. Because what people miss out on Social Security is it's not run like a pension fund. It was not set up to be there to provide everybody 15, 20 years worth of retirement. It was basically to get you from your expected life expectancy to whenever you actually died. And so that's how they came up with the retirement ages. That's how they came up with everything else. Well, now people are using Social Security for 13 to 20 years when it's not just set up to do that. If you only got back what you paid into it, the average worker would only get Social Security for 5 years. So it's not just this big trust fund sitting there. So I do see the younger politicians coming in, making the hard choices. Number one, because people my age and younger just assume Social Security is not going to be there anyways. So they might find ways to sunset it. Hey, maybe half of our 7% that's going into Social Security and Medicare goes into a private retirement fund. You know, we have these Trump investment accounts that are, I think, being created to start next year for newborns. I could see younger members coming up with an alternative to Social Security to kind of sunset it. So I think there's a lot of good ideas out there. We just need somebody new to come in with all things. You know, we're all good to listen to other ideas and see what they're there. So hopefully, again, that's bigger picture, but that's something that we see, and we're very positive on the future. We do think that our country will be able to right things where they need to go, and that we will continue to be the most um, strongest economy in the world. We have the best demographics in the world, the most creativity in the world. We're going to get there. We just got to get through this gap of the K-shaped economy without imploding. And I think that there's a lot of good ideas to keep us from doing that. Um, so with that, Tony just said a follow-up, and I do appreciate this. Tony said, we chose SEM for the downside protection, not the upside. Upside's just a bonus. We are thrilled. Truly appreciate you, Tony. We wish you well. We hope to help you during your retirement. We hope to help everybody during their retirement. We really want to help everybody out there. The one reason we're doing the financial literacy with Money Talks with Dad is we want younger people out there. We do free financial plans for anybody who starts with our questionnaire. And if it's just, hey, you need to pay down your debts, that's your plan for the next 5 years, we're there to help. So if your kids or grandkids need help getting started, have them check out Money Talks with Dad. And we can do free consultations and things like that. If you're an advisor, we want to continue helping your clients, not just those who are retiring, but those younger clients. So that was a long Q&A. I thank you, everybody who stuck it out. whether you're still listening or not, hopefully when this posts, either later today or tomorrow, you'll get an email with the replay link. So with that, we are going into our busiest time of the year. A lot of tax harvesting to do, a lot of rebalancing to do, obviously a very wild market to do. But I hope everybody has a very Merry Christmas, a very safe Christmas. Keep things in perspective. If you need help, go to risk.semwealth.com and we can do a free portfolio review. So thank you everybody for joining us.